Hello, this is Craig Mitchell, your personal mortgage consultant for life. And this video that you're going to watch today is an excerpt from one of my first-time homebuyer seminars. So if you're a first-time homebuyer, this is information you definitely need to know. And even if you're not a first-time homebuyer, I can almost guarantee that most of the information will be new to you, so you can definitely benefit by watching it. If you do have any questions or comments after watching the video, please email me or call me, and my contact information will be provided at the end of the video. Alright, so today we're going to talk about how you can guarantee that you're going to get the best deal on your home loan when you purchase a home. And in order to make sure that you're going to get the best home loan, you have to know the difference between what's called your interest rate and your annual percentage rate. You see, whenever you apply for a loan, whether it's a car loan, a home loan, or a personal loan, your paperwork will have two different interest rates. One is called the interest rate, and the other one is called the annual percentage rate, also known as the APR. Usually, the annual percentage rate is much higher than the interest rate. Now, this can be a little confusing because when you're talking to your loan officer, they're going to quote you an interest rate. But when you see the paperwork, you're going to see a form that shows the annual percentage rate, which again is going to be much higher than the interest rate. And almost without fail, whenever I send out paperwork to one of my clients, I almost always get a call asking, why is the interest rate higher than what I quoted them over the phone? And it's important that you know the difference, because if you're calling different banks to see who has the best deal, you can't just look at the interest rate, you have to go off the annual percentage rate. And if you don't understand the difference between them, you might get stuck with a bad loan. Your interest rate is what most people are familiar with. It tells you how much interest you're going to pay on the loan and how much your monthly payment is. Your annual percentage rate, your APR, is showing you how much interest you're paying on the money that you borrow, excluding closing costs. And I'm going to give you an example of how this works, because trying to explain this without an example is virtually impossible. So for this example, let's say that you borrow $100 with an interest rate of 10%. So in this example, in 1 year you would pay $10 in interest, because 10% of $100 is 10. To figure out your APR, your annual percentage rate, we need to know how much your closing costs are. So for this example, let's say your closing costs are $5. So even though you borrow $100, you're only getting $95 since you have to pay $5 in closing costs. So the way your APR is determined is you take the amount of interest that you pay in 1 year, which is $10, and you divide that by how much money you receive after the closing costs, which is $95. So it looks like this. 10 divided by 95 is equal to 10.526. So your APR is 10.526, which is obviously higher than your interest rate, which is 10% even. So that's how your APR is calculated. And now that I've done my best to unconfuse you, if that's even a real word, I don't know, but you're probably wondering, why do you even need to know the APR? What's it for? What's the point of the APR, and how does knowing the APR benefit you? And the APR really serves only one purpose. It lets you compare different loan programs to see which one is best. What you may not realize is when you get a home loan, you can actually pick your own interest rate. The lower the interest rate you choose, the higher your closing costs are. And I'm going to give you an example so you can see the difference. And for this example, let's use a loan amount of $100,000, just to make the math easy. So as you can see from the three examples on the screen, we have three different loan programs. Number one has an interest rate of 6% with closing costs of $2,000, a monthly payment of $600 per month, and an APR, an annual percentage rate, of 6.122. The second loan program has a lower interest rate. It's 5.875. It has $3,000 in closing costs, so the rate is lower, the closing costs are higher, and it has a payment of $591 per month, so your payment is lower also. And the APR is 6.057. Now for the third option, we have an interest rate which is even lower at 5.75. Again, the closing costs are a bit higher because the lower your interest rate, the higher your closing costs. So the closing costs are $5,000 and your payment is $583 per month with an APR of 6.117. So how do you decide which program is better? Do you take the program with the lowest closing costs or the lowest payment, or do you take the program right in the middle? Well, in this example, as you can see, the APR, which is your furthest number to the right, is the lowest on the middle program, which has a rate of 5.875. So technically, that's where you're going to get your best overall deal. Now, typically, a good loan officer is just going to give you the best APR that they have. So usually the only time you're going to need the APR is when you're comparing quotes from different banks. So for example, if you go to Bank of America and Wells Fargo, which by the way I'm not recommending because their rates are not always the best, but for this example, let's say you get a quote from each bank and the interest rate and closing costs are different. Well, as you can see from our previous example, the lowest interest rate is not always the best loan. So when you're comparing different banks, you want to look at the annual percentage rate, the APR, to see who's offering you the best loan. And as long as you're picking the APR that has the lowest rate, technically you are getting the best loan. So anyway, I hope this all makes sense. However, if you do have any questions, feel free to give me a call or shoot me an email, and I'll see you next time.